A global crisis is on the horizon. Apple has become a problem. These and other questions have arisen in recent days due to news involving the world's largest investor, Warren Buffett. It was reported that Berkshire Hathaway, the Oracle of Omaha's company, has sold almost half of its Apple shares, which previously represented nearly 50% of its multi-billion-dollar portfolio. Additionally, with the sale of these shares, Buffett's business now has more than $277 billion in cash, an absolutely staggering and unprecedented amount to date. What is most alarming is that this is the highest cash reserve Buffett has held since 2005, 3 years before the 2008 financial crisis. But in the end, what is happening? Is it an Apple problem, or is it the precursor to a global crisis? In this video, you will find a series of reasons that will give you the elements to draw your own conclusions and understand that not everything boils down to a single operation. Warren Buffett, at 93 years old, the world's greatest investor, still surprises and stirs up the financial market, and his moves can signal both problems and opportunities. After all, he alone has a fortune valued at more than $135 billion, and his firm, Berkshire Hathaway, holds nearly $1 trillion in assets under management. The most recent move was the news that the billionaire sold almost half of his Apple shares, a company he invested in back in 2016 after realizing it was a revenue-generating machine. From then until now, he has allocated more than $34 billion in Apple stocks, an investment that reached a valuation of over $169 billion this year. However, despite praising the company over the years and being known for his long-term investments, Buffett surprised much of the world with this transaction. Months earlier, he had already indicated that he had sold some of the shares, but not nearly as significant a percentage as now. Due to the enormous volume sold, a series of speculations have arisen about the real reasons the investor has apparently lost a significant portion of his faith in the company's stocks, sparking projections that the move goes far beyond the situation of a single company. Regarding Apple, there are likely justifications indicating the investor's dissatisfaction with the company, aligning with Buffett's historical approach over the decades. Besides being known for long-term investments in well-structured companies with intrinsic value, Buffett sought businesses that stood out in very well-known and well-regulated sectors. These sectors provide predictability to the investor, who knows they won't face major surprises, whether due to new laws or regulations that could completely change a market, or because in well-regulated markets, only a few companies stand out. And these few companies tend to capture a good market share that increases with good management over the years. This is how he composed his portfolio, primarily with market giants like Coca-Cola, Chevron, Kraft Heinz, and financial institutions like Wells Fargo, Bank of America, and American Express. The problem is that when it comes to Apple, some analysts point to possible vulnerabilities that could put the business at risk in the coming years. One of them touches on the philosophy mentioned earlier. Apple operates not only as an electronics manufacturer, but also as a provider of services and products linked to technology. On the one hand, this brings a blue ocean for innovations and the potential navigation in emerging and underexplored sectors, such as the artificial intelligence market, which could bring enormous profitability. The problem is that, while entering a market with few rules can be highly lucrative, it can also mean significant losses once regulations come into play. In other words, the investment could be deeply affected by a single stroke of the pen or new bureaucracy that the market has not yet priced in, unlike the sectors in which Buffett has historically operated. When it comes to regulation, it's not just about laws, rules, or agreements but a complete shift in the landscape, whether due to a political decision or a judge's ruling. A recent example of this is the ruling that determined Google has become a monopoly in the internet search market, which could have implications not only for Google and its parent company, Alphabet, but also for the entire tech market, including potentially against Apple. And anyone who thinks this is an unprecedented problem is mistaken. At the turn of the century, Microsoft was severely prosecuted by the United States Department of Justice and, After being practically recognized as a monopoly, the company had to make a series of agreements and concessions to avoid being split into two or more companies, as was the case with the oil giant Standard Oil in the early 20th century. The outcome kept Microsoft as a single entity but significantly delayed its plans, which could have made the giant the absolute reference in the tech market across various sectors. The situation resulted in over a decade of skepticism about Microsoft and below-expected growth. Other specific issues also raise alarms about government interference in the tech market, particularly against Apple, which was fined nearly $2 billion in March this year in Europe for steering customers within its app market towards subscribing to its own music app instead of competitors. Moreover, Apple could face this effect and more in one of its largest markets, China. Besides being just a stroke of the pen away from losing its operations in the country due to long-standing issues with the local government, Apple is deeply interconnected with the Chinese market, both from the perspective of local consumers and due to its reliance on Chinese labor and technology for manufacturing its electronics. In other words, the China factor is seen as a double concern that could implode the giant's business, and the Chinese market may have also lost its appeal for Buffett himself, as he has been reducing his stake in the Chinese automaker BYD, an investment of over a decade. In 2008, Buffett acquired 10% of the automaker, but currently, he holds about 6.9% of the business. Recently, he sold a small percentage of shares even after the automaker surpassed Tesla as the world's largest electric car manufacturer. Earlier this year, Warren Buffett gave a valid justification for selling some of his Apple shares, which opens the door to a much larger problem. According to him, the sale of 13% of the shares he held earlier this year was a way to realize some of the extraordinary gains accumulated over the years, taking advantage of the fact that the U.S. tax burden still favors this type of transaction. For the Oracle, in the short term, the trend is for the American government to be forced to significantly increase capital gains tax rates to cover the massive public deficit that has grown sharply in recent years. However, with the massive sale of Apple shares in recent days, the impact has become negative for both the company and the business environment as a whole. Regarding Apple, the sale of the shares may indicate that the magnate believes the company's valuation has peaked and that in the coming months, the trend is for the stock to face a series of problems, either due to internal or external forces. Even Apple itself has stated that it expects weaker sales in the coming months. The same can be projected for other tech companies as well. Do you think tech companies are in trouble, or is it just an Apple problem? The issue is if the problem isn't limited to just one company, but to the market as a whole. And this is where the billionaire's other moves become impressive. In addition to selling Apple shares, the billionaire has also reduced part of some of his other investments, notably selling $8 billion worth of Bank of America shares, a long-standing investment by Buffett in a sector considered strong. Nevertheless, the magnate remains the largest shareholder of the financial institution. But the big warning comes in how Buffett has been moving his accumulated capital in recent years. With a series of sales, the mega investor has reallocated part of his capital into U.S. Treasury bonds, totaling $2.6 billion. The most impressive thing is that Berkshire now holds more U.S. Treasury bonds than the Federal Reserve, the U.S. central bank. In total, there are $234 billion in bonds, while the Fed holds $195 billion, indicating a search for a theoretically safer place than the volatility and competition of the corporate world, especially when central banks worldwide signal interest rate hikes, which could further undermine the financial market and dynamics between companies, particularly tech companies, as they have already suffered considerably from interest rate hikes alone. Moreover, as already mentioned, the billionaire now holds over $277 billion in cash, an increase of $88 billion from last year to now. According to Berkshire, the money isn't invested due to a lack of opportunities or companies that meet the firm's criteria. On the other hand, the cash accumulation could indicate preparation to take advantage of a severely depressed market in the coming years, with unbeatable discounts. Some analysts find the accumulated amount troubling not because of the exact figure, but rather as a sign that the billionaire is already preparing for the worst, since he hasn't held so much cash since the end of 2007, less than 3 years before the 2008 crisis hit. So, do you think a serious problem is coming in the next few months? However, it could be that Buffett and his associates' moves are due to an internal factor rather than external ones. This is because, with the passing of his right-hand man, Charlie Munger, and the advanced age of the Oracle of Omaha himself, the succession for Berkshire's next leader is already being prepared. For now, the successor is expected to be Greg Abel, who, despite not having a set date to take over, may inherit the firm with plenty of cash and the freedom to make decisions that will shape the company's new investments for the coming decades. And you, which of these situations do you believe will unfold? Is it a general problem, a business crisis, or just a local issue? Share your opinion with us in the comments.